Morning, everyone, and thank you very much for joining. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com. And today is Wednesday, the 15th of June, 2022. Just going to bring up our high risk investment warning. I'll keep this on screen for a few moments. It is Wednesday, so we're going to only go for well, just taking a look at the time now, we'll only go for about another 17 minutes. Then we're going to switch to the crypto minute. We'll do the crypto minute, which is a weekly webinar. And I'd like to keep these separate for a few reasons. First reason, of course, just want to upload them separately on our website. Secondly, compliance issues probably are best dealt with keeping them separately. So we'll do that. Here's our market commentaries disclaimer. I'll keep this on screen for a few moments. Good morning, Raj. Hey, Katie. Nice to have you on the webinar. Thank you very much for joining. As always, it's a pleasure, and I seriously appreciate everyone attending. Thank you very much. Let's take a look at our references here. So we will use MarketScope for some analysis. I think we need to go through the CNBC.com morning report just to know what the market is dealing with. And then we'll look at TradingView. So TradingView is actually it's quite interesting. So we're going to take a look at these charts in a moment. But before we take a look at those charts, let's just go ahead and go through the headlines. This is off of CNBC.com, and it reads as follows: European markets head for positive open ahead of Fed rate decision. So there, right at the beginning in the headline, what's the big highlight of the day? The Fed rate decision. Okay. European stocks are expected to open higher on Wednesday as global markets await the latest monetary policy decision from the US Federal Reserve. The positive open expected for regional markets on Wednesday comes after several trading sessions in Europe, Asia, and US marked by volatility and nervousness as anticipation grows that the Fed, as well as other central banks, will resort to aggressive interest rate hikes to curb rampant inflation. The Federal Open Market Committee is widely expected to announce at least a 50 basis point hike on Wednesday, having already raised rates twice this year. Although market bets for a 75 basis point hike have risen in light of Friday's inflation reading, with the US Consumer Price Index report released for May coming in hotter than expected at 8.6% annually. Ahead of the rate decision, shares in Asia Pacific were mixed, with markets also reacting to the latest Chinese economic data, including industrial production and retail sales for May. US stock futures rose slightly in overnight trading late Tuesday as investors anxiously awaited the Fed's decision. There are no major earning releases in Europe on Wednesday. France releases its inflation data for May. Okay. Is there anything here? I'm just seeing if there's anything that we need to talk about just off the bat. Okay. Let's take a look at this chart on TradingView. I think it's a good. Yeah, so Rob's saying, did I see the ECB emergency meeting? I just saw the headlines, Rob. So European Central Bank announces emergency meeting to discuss the market route. So that's the headline. I'm not quite sure what they'll be able to do, to be quite honest. All right, take a look at the top chart here. All right, we've got. So what I've done here is I've taken the British 2-year, and I'm getting a spread between the 2-year and the US 2-year. So the two sort of, I guess, short end of the two notes on the short end of the yield curve, which is very much a proxy, one could say, for monetary policy, right? In fact, we looked at the US 2-year yesterday, and we looked at the Fed's fund rate as an overlay, and they're very closely related. So we're getting a good indication here. There's a good indication here of the divergence between the two central banks in terms of their monetary policy. In other words, the yield on the 2-year note out of the UK is certainly losing ground against the yield of the 2-year note out of the US. And that's not surprising, because the Fed is aggressive. In fact, we're now debating whether it's going to be a 50, 75, or maybe, shall we just throw 100 in there for interest sake? But I mean, we're talking about a very hawkish central bank, as opposed to the Bank of England, which meets tomorrow. And they are expected to do 25 basis points. And I would suggest, probably reluctantly, they're fighting inflation. There's no doubt about that. But they're fighting inflation into a weak economy. GDP is contracted. The employment numbers that came out were poorer than expected. Industrial production was shockingly weak to the downside. And that's what the Bank of England is dealing with. And not only that, the communications between the two banks are starkly different. Where we've had the Fed officials being quite sort of bold in terms of their hawkishness, the Bank of England in their previous statement were quite pessimistic. We're going to reach double-digit inflation most likely by year end. That's what it said. However, we're going to see some GDP contraction. There was a very I think a significant dissent in the Bank of England monetary policy decision last time, where I think there were some calls for 50 basis points as opposed to 25 basis points. They went with 25. Why would you choose 50? And the reasoning for choosing that 50, I think, is key. It was actually a dovish 50 basis point hike. Now, how can that be? It's because they wanted to front load. They wanted to front load the interest rate hikes, because the likelihood of them being aggressive later in the cycle was, well, the odds were, were small. We had and the kind of that window is now gone, and you can see, well, what's the result of the this sort of yield spread that is clearly in the favor of the US 2-year. Well, take a look at the pound UK. Take a look at pound US dollar, and you can see how cable has actually quite interestingly followed the spread down, right? So as the spread widens in favor of the US, so that is felt in the cable pairing. What we can even do here, let's add in a correlation coefficient. Let's see how closely these guys are correlated. So we just throw in a correlation coefficient. Okay, we'll put in the FXCM, and here's the correlation coefficient. That's a very strong correlation there. We've got a correlation of 86%. In other words, the pound US dollar pairing is moving in an 86% positive correlation with the movement in the short end of the curve, the spread between the two instruments. So what does that mean for us as traders? Well, I think it's something that we certainly have to take note of. And the reason that we have to take note of it is because there's an opportunity. Okay, so you take a look at the daily chart here, and what's happening on the daily chart is that we've got cable slipping into zone 3 between the lower blue and the lower red. But that's our bearish area. Well, it would be bearish for the pound, bullish for the dollar, right? So we've slipped there. Take a look at the momentum. That's the key, right? We've just gone, okay, we've just gone into the lower quintile. Well, that's strong momentum. The longer we stay in the lower quintile, the greater the likelihood of further pound devaluation against the US dollar. So, and that, of course, seems to be driven by underlying fundamentals. What's the underlying fundamentals? Monetary policy. There's a divergence in their aggressiveness. Yeah, the Bank of England's hiking, but they're hiking at a much less aggressive pace than the Fed. Well, that's opportunity. Now, we've got some blue coming in this weakness. Well, that's something now to take, that we have to take note of. Why do we have to take note of that? Because that is your rally in the downtrend. So we want to go down to the hourly now. So we go down to the hourly, and we want to keep a close eye on the hourly, because this is where we're going to try and see if there is meaningful resistance. And if there's meaningful resistance, can we take advantage of that? So you can see we've got the central pivot as immediate resistance. If we go ahead, well, I think the R1 level is fairly interesting, because there is an overlap of pivot resistance with price resistance. So that in itself is something that would be of interest. Now, we've got to say something very obvious, and that is any trade that is taken today, the closer you get to the Fed announcement, the higher the risk. So you take let's just say we take a long or a short position, right? Let's say somebody takes a long position into cable. Let's say somebody takes a short position into cable. Well, depending on how the Fed announcement is interpreted by the market, is it more hawkish than expected? Is it more dovish than expected? Is it exactly as expected? Or how do we discount all those possibilities going forward? And we're going to see just a huge spike in volatility, and that means there is going to be heightened risk associated with this, with whichever side you decide to take. For me, given that we've got a very obvious downtrend here, okay, so this is on the weekly, given the fact that we've got the yield spread showing a very obvious correlation to cable, given the fact that we're clearly in zone 3 and we've gone now into a potentially strong momentum area, any sort of rallies here become targets for shorts. It just seems to make the most sense. That, by the way, can change. You know, the fundamentals are constantly in flux. Now, what we've seen with regards to the UK over the last few days is the contraction in GDP. We've seen the contraction in industrial production, and we've seen the labour market show signs of weakening. But that's probably going to happen in the US as well, just by the way. So if that happens in the US, we need if capital I, capital F, it probably is going to happen because we're in that kind of stagflationary environment. But the US is more shielded than Europe, UK, right? So the idea here is if the recessionary pressures start seeping in to the US data, how does the Fed react, and does that affect the spread? Because I think that if the spread gets affected, in other words, if something causes the spread to start moving in that direction, and if the correlation remains at such a strong level, well, then we would see probably pound appreciating, revaluing against the US dollar. but those are obviously all hypotheticals. They're all assumptions now. We've got to see if the data does change. I'm suspecting it will, but who knows, right? Katie asking for Nasdaq and oil. We'll have to do it very, very quickly. Just got 3 minutes left here, Katie, so we'll go through it very, very quickly. Let's just do it on MarketScope. Okay, so let's bring up Nasdaq first. Probably the easiest of the two. All right, you start weekly. All right, so well, this actually worked out. I can't remember drawing these in, but whenever I did, they worked out quite well, didn't they? So we've got the lower peak, lower trough. Well, here's the next lower peak. Here's the next lower trough. Downtrend and momentum. That's the key. Are we going to stay in this lower quintile? If we stay in this lower quintile, well, Nasdaq carries on trending down, and we're not oversold yet. So if we're not oversold, there's still scope for downwards movement. Take a look on the daily moving into that lower quintile area again. Go through to the hourly. Well, now it's all about our signals, KD. I don't know if we get a crossover to the downside. I don't know if we get a crossover to the downside, but if we do, well, there's your triggers right there. And if we get to 20, well, then the short most likely pays off. What's the I guess the fly in the ointment? It's the Fed meeting. Okay, so if the Fed comes out with a comes out with something that is seen as less aggressive, Nasdaq's going to bounce hard upwards, despite whatever kind of analysis we have here. It's going to any dovish, any hawkishness that is less hawkish than anticipated, that's going to benefit the Nasdaq. Anything more hawkish than expected, that's going to hurt the Nasdaq. Let's just go through oil. So I brought up the wrong thing here. Does the same thing go for Euro US dollar and the Bund? Yes, I suspect that it does, Anna. But again, the fact that the US dollar is your quote currency of Euro US dollar, to me means actually the Fed has been driving the Euro US dollar for the longest time, because the ECB has been so far behind the curve. Now that they're starting to move, the answer to your question is yeah, we will need to definitely keep an eye on those spreads. Also, what's interesting about those spreads, Anna, is that the spread kind of lost its correlation with the Euro US dollar as soon as Bund went negative. Okay, but we're moving out of that negativity, so I suspect that the correlation reasserts. But we'll have to, I think, if we examine that tomorrow, I think we'll have more time to do that. But but my thinking there is that it probably does hold for that as well. Let's just take a look at oil, and then we're going to cut through to the crypto minute. All right, so let's take a look what's happening here. So we saw oil break this continuation pattern, and it's moving towards the upper quintile here. Let's just keep an eye on that. It's going to reach 80. If it reaches 80, we're in big trouble. Globally, we're in big trouble because that just adds to that stagflationary scenario. This is on the weekly, Katie, so you can see that there's some ramifications right here. There does seem to be a resistance level. Let's just take a look at the daily, and you can see that the resistance level is being reflected in the daily. Okay, because it's kind of now testing the zone 1, zone 2, right? And you can also see that the the daily momentum starting to roll over. So probably some weakness coming into oil on the daily, but I suggest that you know, the longer term price action here does still seem very supportive for oil, and we're kind of fighting this 125, 120 level. So that's where the action is at the moment. I think that resistance, by the way, Katie, looks to be quite formidable. Okay, it just seems that 125 is sort of you know, I guess like branded in the psyche of the market. So I think this 125 is a really strong level, and we're just going to have to see how the market reacts. Let's make it kind of between 120, 125, and so I think on the lower time frame, let's say range bound between two very strong levels. The bias, I would suggest, is probably still to the upside, but there's no doubt that the momentum has waned, hasn't it? But the bias certainly still to the upside. With that all said and done, let's conclude at this point. Let's go through to the crypto minute and continue on that webinar. Thanks very much, everyone, for joining, and I'll see you on the next webinar. Thanks, guys.